Today I want to talk about the statement that the Fed made, but also the summary of economic projections, the outlook provided by the Fed presidents with that meeting. The statement begins, as read by Joe Powell, that recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have remained strong and unemployment has remained low. Just as an exercise, what I then did after reading that statement was I looked at what's really the relationship for both the Federal Reserve and the Australian Central Bank about what's the relationship between employment growth and strong job gains, and whether or not the Fed or the RBA then is prepared to cut rates. And what I found when I looked at the data, and it's probably a pretty obvious conclusion, that when year-on-year growth rate in jobs, either in the US or Australia, is growing higher than the long-term median, then the central bank tends to increase rates. And when the year-on-year growth of employment, either in Australia or the US, is growing less than the long-term median, then the central bank tends to cut rates. So then, armed with that information, I looked at where those benchmarks are. Where are the trend growth rates of US employment, and where are the trend growth rates of Australian employment? And I found that for the last around 20 years, the median growth rate in US employment is 1.6% per year. And why that's interesting is for the year to date, the year-on-year growth rate in US employment is 1.8% for the past year. So we're growing, the US economy is growing faster in employment than long-term median, and that's a time when the Fed never cuts rates. So what we've got to do is we've got to wait for the US economy to slow down and that number to fall below that long-term growth rate of 1.6% in order to be in a situation where unemployment is then going up and the Fed is likely to cut rates. But it hasn't arrived yet. And the same, interestingly, is the case in Australia. When I looked at the most recent employment numbers, and they were only released last week, what I found was that the median long-term growth rate of the Australian workforce is 2.1%. We actually, on average, grow faster than the US. But right now, that growth rate of employment in Australia is 2.4%. So it's above the level in which the RBA would cut rates. And hence, rates aren't going down, and they're not going to go down until employment growth falls below that long-term median. So it's kind of a handy, simple way of getting a feel for what's actually happening in the economy and the way central banks look at it. The summary of economic projections, of course, is the thing that is the most widely reported thing about Fed meetings. The summary of economic projections only is released 4 times a year. And in that 4 times a year, what the members of the Open Market Committee and the Fed presidents who are on the committee, or including those who aren't on the committee, in fact, they provide their estimates of where inflation is going to go and where unemployment's going to go and where the Fed funds rate's going to go. The summary of economic projections said this time was the growth this year is 2.1%, and it's not going to slow much in the next couple of years. It's going to be 2% next year and 2% the year after. So that's really interesting. The growth is going to stay at that level because the Fed thinks that the long-term average growth rate in the US economy is only 1.8%. So that's pretty good growth rate. They think that unemployment will end this year at 4%, but only go up to 4.2% next year and stay around about that level. As a matter of fact, that they think that's the long-term average level of unemployment. They think that the PCE deflator this year will be 2.6%, and that's higher. And sorry, that's higher than the March projection of 2.4%. And that's really interesting because in the press conference, Jay Powell was asked what has changed in the view of the Fed since last time, because last time the Fed was showing multiple rate cuts this year, and this time it's only showing one rate cut this year at the very end of this year, perhaps. And he was asked what has changed, and he said, and I quote, "The big thing that has changed was the inflation forecast. It will now take longer for us to get confidence to ease monetary policy." So it's that small increase in inflation expectations from this year from 2.4% to 2.6%, which is the reason that the Fed believes it can't cut rates until the end of the year. It can cut rates at the end of the year because it thinks that next year the inflation number is going to go down to 2.3%, and by 2026 it's going to go down to 2%, which is their long-term target. So that's that small change in the inflation forecast is the reason that they put off rate cuts to the end of the year. Where do they see the Fed funds rate going? They think it will be, it's now 535 basis points. They think it will be 5.1% by the end of this year. They think there'll be another four rate cuts next year, taking down to 4.1%. Remember that our cash rate is 4.35%, so it won't be right until the end of next year that the Fed funds rate is lower than the Australian cash rate, assuming we don't move. And then rates fall another 100 basis points to 3.1% at the end of 26. And in the long term, they think the Fed funds rate's going to fall back to 2.8%. So as the US economy slows down, and they hope it will slow down and employment will slow down over the year ahead, the Fed will be able to start cutting rates towards the end of this year, given the fact that the Fed's position can change on very fine changes in inflation expectations. I think we'll have to wait for the next meeting to find out what's really going to happen.